Welcome to Talk Tickers, everyone. So on February 2nd, Rambus dropped their Q4 earnings, and on paper, they looked absolutely fantastic. A stellar quarter, right? But then, the market's reaction was, well, brutal. Today, we're going to dig into exactly why a seemingly great earnings report can sometimes trigger a complete bloodbath for a stock, and more importantly, what this all means for Rambus now.
And when I say brutal, I mean brutal. The stock just got hammered, first and after hours trading, and then by the time the market closed the next day, it was down a staggering 13.7%. And look, this wasn't some small move on late trading. We're talking nearly 3 times the average daily volume. A lot of people were selling fast. So you've got to be asking yourself, what gives? The results actually beat expectations. So why did investors run for the exits like the building was on fire? That is the big mystery we are going to unpack right now. Okay, so before we get to the drama, let's start with the good stuff. And honestly, there was a lot of it. Management was, justifiably proud of these numbers. Q4 was a really strong finish to what was a record-breaking year for them. The fundamentals looked totally solid. Let's talk revenue. For Q4, they pulled in $190.2 million. Now, that's not just a big number. It was a 1.1% beat over what Wall Street was expecting, and it's up a very healthy 18% from the year before. So far, so good. Absolutely no red flags here. And that momentum, it carried right on through to their product revenue, which is, a huge growth driver for them. It hit a new company record, $96.8 million for the quarter. This is the part of the business everyone's watching, and man, it was just firing on all cylinders. And then to just round out this pretty picture, their non-GAAP earnings per share landed at 68 cents, right on the money, exactly what everyone was expecting. So again, no nasty surprises here, just really solid execution. Check, check, and check. And the CEO, Luke Serifin, he really leaned into this on the earnings call. This is how he kicked things off, emphasizing the record results, the excellent performance. You get the picture. The story they were telling was simple. Everything is great. But the market? It heard something completely different. And here it is. This is the exact moment where the story takes a 180-degree turn. See, the market doesn't really care about what you did last quarter. It cares about what you're going to do next quarter. And the future? Well, the future that management painted with their Q1 guidance, it looked surprisingly weak. Just take a look at this table. You see that sequential drop? Total revenue guided down, okay? That can happen. But the real flashing red light here was the product revenue. I mean, they just posted a record $96.8 million, and now they're guiding for somewhere between $84 and $90 million. That's a huge step down, way more than you'd expect from just normal seasonality. This was the smoke, and you can bet investors started looking for the fire immediately. So what was the fire? Well, management was pretty direct about it. The CEO came out and said plainly that a, quote, one-time supply chain issue was the culprit for that weak Q1 forecast. And notice how he was super quick to add that the issue was already resolved. They were trying really hard to frame this as just a temporary blip, not some deep structural problem. And during the Q&A session, they gave a little more detail. So here's the deal. There was a manufacturing hiccup with one of their supply partners. It only affected a tiny number of parts, but ironically, the fix is what created the problem for Q1. See, to meet all that strong demand in Q4, they had to pull some fresh inventory forward from Q1. At the same time, they were being extra careful, quarantining and retesting a bunch of material. And that whole process created this capacity crunch that's now hitting their Q1 shipments, a bit of a domino effect. Okay, so you're probably thinking a temporary issue that's already fixed caused a one-quarter revenue gap? Why did the stock get a 14% haircut? And that is the right question. To understand that, you have to zoom out and look at the context. This wasn't just any old stock. This was a high flyer, a stock that was, for all intents and purposes, priced for absolute perfection. And this chart really tells you everything you need to know about why that stumble mattered so much. In the year leading up to this report, Rambus was up, get this, over 76%. It was absolutely crushing its sector, the semi-ETF, and the S&P 500. Look, when a stock is running that hot, it's priced for perfection. There is zero, and I mean zero, room for error. So as you can imagine, this guidance miss and the stock drop that followed immediately split Wall Street right down the middle. It's created this really clear debate between the bulls, the folks who think this is a great buying opportunity, and the bears, who see a serious crack in the company's story.
All right, let's break down the two camps. On one side, you've got the bulls. Think Rosenblatt, who came out and reiterated their buy rating and a $130 price target. They're basically taking management at their word. They're saying, hey, the issue is temporary, the long-term story around AI and DDR5 is totally intact, and their balance sheet is a fortress. But then you have the bears. They see a lot more risk now. Evercore, for instance, cut their price target. For them, this whole thing creates a messy setup. It clouds the near-term picture and, maybe most importantly, puts management's credibility on the line.
So after all that, where do we land? Let's get into our rating and our thesis for what's next for Rambus. We're giving this a rating of market perform. And here's why. We think the stock, after that drop, is probably fairly valued. It's balancing two things. On one hand, you have those very real, very strong long-term fundamentals. But on the other hand, you've got this significant new uncertainty that's just been thrown into the mix for the near term. So our thesis is pretty simple. Rambus has officially become a show-me story. All the good stuff, it's still there. The strong DDR5 market share, the AI tailwinds, that solid balance sheet, that hasn't changed. But the bad news is that the price for perfection narrative has been shattered. The story of flawless execution, it's broken. So now, the number one question is, can management actually prove the supply chain thing was a one-off event? Until they do, we think the stock is probably going to be stuck in a range. The ball is completely in their court now. They need to deliver a clean beat and raise next quarter to get investors back on board. Now, whenever you have a situation like this with all the pressure on management for the next report, it sets up a really interesting trade. It's what we like to call our outrageous but plausible trade. So let's talk about how you might play this. Okay, we're calling this one the Q2 credibility trade. And really, it's almost an all-or-nothing bet on that next earnings report, because that's where the entire market's focus is now. Here's the setup. If they hit their lowered Q1 numbers, and this is the critical part, if their Q2 guidance shows a sharp recovery back to over $100 million in product revenue, that proves management was right. It really was a one-time thing. If that happens, you could see a massive relief rally, just a huge jump as big investors pile back in. But here's the risk, and it's a big one. If there's any hint of lingering weakness in that Q2 guidance, it confirms the bear case, and the stock could easily take another big leg down. The next report is basically a coin flip with huge moves in either direction. And of course, we have to say it, this is not financial advice. Everything we've talked about today is just for informational and educational purposes. So please do your own research.